Hello everyone, my name is Professor Troll. This is my first video on YouTube. I hope you will like it. I advise you to watch it till the end as it will make really a difference on how you classify your cash and cash equivalents in accordance with IAS 7. Well, what is cash and cash equivalent? Well, first let's define cash. Cash can be cash on hand, the dollars you have in your pocket. Demand deposit can be your saving or current bank account. You can find below some of the differences between these accounts, but both meet the definition of cash. Cash equivalents are short-term, highly liquid investments that are readily convertible to known amount of cash and which are subject to an insignificant risk of changes in value. A great example will be a term deposit with an original maturity of less than 3 months. And I should emphasize the fact that it is the original maturities that count. A second example will be money market securities, like treasury bills. So let's start with some examples. Assume a 31 December 2016 year end. Is a term deposit starting on 1 December 2016 and maturing on 31 December 2017 a cash equivalent? Obviously, yes, the answer is. The term of this deposit is shorter than 3 months. It's actually 2 months from 1 December 2016 till 31 January 2017. We have only 2 months and therefore it is considered to be part of cash and cash equivalents. You can see below all the term deposits examples we can have with different maturities, with different interest rates. Accordingly, based on each original maturity, the classification will be based. For those with original maturities of less than 3 months, obviously the classification will be part of cash and cash equivalent. For those with maturities between 3 and 12 months, the maturity will define actually its classification, which is part of current assets. For those with original maturities bigger than 12 months, the classification will be part as of non-current asset. This is a second example. Assume a 31 December 2016 year end. Is a term deposit starting on 1 December and maturing on 31 May 2017 a cash equivalent? Obviously, the answer is no. The term of this deposit is greater than 3 months and therefore it's not considered to be readily convertible. The term readily convertible implies that an investment must be convertible into cash without an undue period of notice and without incurring a significant penalty on withdrawal. So for this term deposit, obviously, if you need to cash your money before maturity, you will need to pay significant penalties, and accordingly, you will not be able to classify this account as part of cash and cash equivalent. It will be classified outside cash and cash equivalent, and it will be the account will be named, let's say, term deposit on your balance sheet inside the current assets, but outside cash and cash equivalent. We have here a third example. Assume a 31 December 2016 year end. Is a term deposit starting on 1 August 2016 and maturing on 31 January 2017 a cash equivalent? Pay attention to the trick actually. The answer is no. We know that the maturity will be in less than 1 month or in 1 month actually, but IFRS and IAS 7 define classification based on original maturity. So the trick here is not to consider how much is left from maturity, but to consider original maturity. So the original maturity was 6 or 7 months from 1 August 2016 till 31 January 2017, which is actually bigger than 3 months. Therefore, this term deposit cannot be classified as part of cash and cash equivalent, and therefore it should be part of your current assets and outside the classification of cash and cash equivalent. An entity must disclose the component of cash and cash equivalents. It must also present a reconciliation of the amount in its statement of cash flow with the equivalent item reported in the statement of financial position. As you can see below, you will find the components of cash and cash equivalents, which should be disclosed in the notes. As you may know, the financial statements are composed of a balance sheet, an income statement, a statement of cash flow, a statement of changes in equity, and obviously as well of the notes. So the notes should disclose the components of cash and cash equivalents, those that meet the definition of cash, those that meet the definition of cash equivalent. IAS 7 requires the disclosure of cash and cash equivalents that are restricted. For example, if a group owns a company in Venezuela, which is accounted as a subsidiary, Venezuela has put in place a capital control in which the subsidiary cannot transfer its cash to its parent company. Accordingly, its cash on consolidation cannot be used by the group, and this fact should be disclosed in the financial statement of the group.